If you think about what the Weil Distress Index does, data from European public companies, over 3,500, and to get a sort of longer term view, we produce this going back to the financial crisis. So think of the financial crisis as a sort of pyramid of distress, very, very sharp uptick in corporate distress to multiples of the base level of corporate distress. So in 2008, 2009, there's a huge spike, which tails off very quickly to reflect quantitative easing and low interest rates. Yeah. Picks up again a bit in Europe at the time of the sovereign debt crisis, the Greek bailout. And then the pandemic, there's another very significant spike. Not as high as the global financial crisis for the principal reason that the financial crisis was corporates and banks in 2008. At the time of the pandemic, it was corporates, not banks. Yeah. And then it dipped to reflect government involvement. And now, in the last 18 months, has been steadily rising. Yeah. And to just put it in graphic terms, it is about half what it is at the height of the pandemic. So corporate distress across Europe is significantly higher than average, and about half what we got to the pandemic, nowhere near what we saw at the time of the financial crisis.
Very interesting. And let me just ask you a question about methodology as well. How do you define company distress at this point? Are you looking at cash flow, balance sheet, debt servicing numbers? What are the metrics that you look at?
So European public companies, the great thing about European public companies is a lot of data available. You look at markets, you look at profitability, you can look at debt to equity ratios, dividend, cash to service dividend, cash reserves, free cash flow, cost of debt, credit default swaps to the extent relevant. And we track 16, 17 different sets of data and build a model. And then, we've been doing this now for quite a long time and tracked it back to before the financial crisis to make sure that the model behaved in the way that we would expect it to. And critically, we think it is correlated to default rates. So over the years, as corporate distress moves up, so default rates, and we sort of proved that by going back to 2008.
It's so interesting you're saying that, because only this morning UniCredit, one of the banks that reported, also said that they only see a cost of risk of around 12 basis points. So even though there are signs of distress popping up in the system, you don't get the sense that banks have heavily started provisioning for potential losses in the future. So there seems to be a mismatch between what this report is saying and what the visibility looks like for some of the CEOs who have interactions with these corporates.
That's absolutely true, and it's incredibly difficult. I mean, the number of people that have predicted the bottom of the market or upturns in default rates and then lost money are legion. It's important to take a long view, and the markets react to short-term things. What we are showing is a long-term thing, which is about the challenge for corporates and governments in the face of a sharply increased cost of debt. I mean, it is just a fact that cost of debt for governments and corporates is very sharply increased. And I think what we are highlighting is that as companies sort of face that increased cost of debt, it is putting strains on their balance sheets across Europe and resulting in increased signs of distress. Doesn't mean that default rates will get back to anything like they were at the financial crisis or possibly even at the height of the pandemic. But there is no doubt that as we go through this transition to a world of higher interest rates, there will be increased defaults and increased restructurings.
Well, maybe many of these companies are hoping that the central banks actually do go along with the rate cuts this year. But it's not just about higher interest rates, it's also about higher costs as well. We saw massive inflation shock in 2022, 2023. Yeah. And I wonder what your report shows you in terms of how that impacted overall companies' profitability and to what extent these companies were able to absorb those higher costs. Yeah. And obviously that was going to impact the bottom line versus pass on those higher costs to consumers.
Well, that's exactly right. So in a world where European companies are highly profitable, they can absorb higher debt costs and they can absorb higher costs and costs of inflation. But that's not what our survey shows is the profitability is under great pressure across Europe. And the reason why the index is showing higher levels of distress, particularly, is profitability is poor. So companies have got to, if you like, less cushion. And look, it's very hard to predict, the short-term impact of inflation. But long-term, for those that take a view that inflation will remain sort of stubborn across Europe, it's actually moderated somewhat. Rather than going back to levels 18 months ago, inflation will remain. that will be a challenge and feed into higher interest rates.